Hello and welcome to the Golden Thumb Rule, a podcast where we decode investing wisdom through simple, timeless rules. Now, markets move in cycles, booms, slow down, as well as period of uncertainty. But some companies don't just survive these phases. In fact, the energy they bounce back even stronger every time. Now, in this episode, we dive into what truly differentiates resilient businesses from short-lived winners. Now, joining us is Srinivas Rao Ravuri, who is a Chief Investment Officer at Bajaj Life Insurance. Now, Srinivas, great to have you on the show.
Thank you, Kshijit. Glad to be here and to discuss this, one of the most important topic.
Thank you for taking the time out, Srinivas. Now, let me just quickly start off. If you had to define valuation discipline in one sentence, what should be your golden thumb rule for investors?
Our golden rule is growth at reasonable price,
Okay.
or what we call GARP is what we
Well,
follow at Bajaj Life. Kshitij, if you see last 5 years, Nifty has doubled and delivered about 14% compounding returns in the last 5 years. I'm ignoring the COVID part, Jan 21 to now. Nifty 500 companies have doubled. But within that, good 40% of companies, 200 odd companies, have delivered negative returns in the 5 years when market has doubled. And about 15% of the companies have delivered very healthy returns. So the point that I'm making is if you buy at the right price, automatically the compounding will work in your favor.
yes.
But if you overpay,
Yeah.
and if you are paying everything today only for the expected future growth, you can lose money in a good market as well.
Absolutely. Buy at the right price, and that's the that's the question that everyone is trying to answer. But we'll definitely come to that, Shrini, as to what ideally should investors do to make sure that they get it right the first time. But yes, let me also quickly hop on to the next question. So, why do sort of most investors abandon valuation discipline during bull markets? There's a saying that when everyone is talking about markets and when everyone is giving tips, that's the time that you should actually bail out from markets. But over to you on that, Shini.
So markets are governed by fear, greed, and as some people say, career risk.
Yeah.
So which in turn means in bull markets, we tend to see people ignoring the time-tested principles of investing and valuation metrics like price to earnings, and start focusing on narratives. And in fact, professional investors also have this relative valuation phase. X company is trading at 60 PE. It is cheap because Y company in the same space is trading at 80 PE, so it is cheap, so it is better. I think that is one challenge that we have. Other thing is people think people get carried away by the flavor, momentum of the season. Giving an examples like defense, infrastructure, real estate. You think this time is different, they will deliver returns forever. So I think these things we need to be mindful of. So we are here to make money. And the first principle there that we should keep in mind is don't lose money.
Yes. Capital protection is something which every investor should take note of, and that should be his or her top priority. Now, coming to the first point, the first question which you highlighted, the right price to buy. So, what is your thumb rule to decide when a stock is too expensive to buy, regardless how strong the story is?
Yeah, here again, I would like to use a simplistic price to earning
Okay.
metric to say whether a stock is expensive or not expensive. So for a steady state business, I would say, paying 33 times, is fine.
Yes,
What is the logic? So when we say price to earn 33, what are we saying? we are essentially talking about a 3% earnings yield.
Sure.
For a growth company, see, investing in equity is about investing for growth.
Hmm.
So 3% earnings yield plus growth, I think I am fine with that.
Okay.
And within that, let's say a relatively new business, new segment, where high growth is visible today, maybe you can pay up to a 50 PE.
Okay.
So I think anything more than that,
Hmm.
I think margin of safety is definitely a question mark. So I think that is what I would like to avoid as far as possible.
No, no, I understand. In fact, uh, in the new fund offers, only in the IPO only, you could see that there are a lot of companies trade at much larger P's than we just sort of highlighted that this should ideally be the benchmark. So, any word of advice or caution there to investors on that?
Absolutely. See, I think what we need to keep in mind is um, high quality companies can also be poor investments if bought at wrong price.
Hmm.
And as I was giving you numbers, we already see that happening.
Right.
Um, I think first principle I was saying is avoiding big mistakes.
Hmm.
Um, so companies that are in new age, catering to different markets
Yeah.
and demonstrate a long-term growth potential
Okay.
tend to trade at premium valuations.
Sure.
But what is important is sustainability and also keeping in the mind the fact that mean reversion.
Absolutely. Now, definitely, these two are the top priority or the top thumb rules which ideally every investor should remember. Now, let me also get to a question. Yes, we do end up buying stocks, or investors do end up buying stocks, and they might be available or trading at a premium valuation. So it does happen, right? So, what's your thumb rule on paying a premium valuation when is it justified? When can we say that it is justified, or when is it dangerous?
So when there is a long-term reinvestment runway, I'm saying that durability of business growth, earnings growth is visible.
Yeah.
I don't mind paying. I'm saying like, let's say company is addressing a large market
Hmm.
and has a unique business proposition and superior management, which
Hmm.
in turn means this company can deliver. If you see last 10 years, Nifty has delivered 15% earnings growth.
Sure.
But here is a company which is likely to, given all this positives, deliver double that earnings growth. So
Hmm.
I have to pay a higher price. But what we need to keep in mind is, okay, whether this is seasonal, cyclical, or it is much more long lasting.
Right.
If it is cyclical, we should be extremely mindful of paying a high price.
Absolutely. And how should investors think about valuation in high growth stocks? So, what's the golden thumb rule to avoid overpaying for growth?
Um, I think A, focus on business model,
Okay.
whether that underlying business has a potential to deliver sustainable long-term growth.
Okay.
And even if it is doing that, see, I think, Kshitij, it is important to remember, we can't be masters of everything. I'm saying even a professional investors.
Yes. Yes.
So we are not here to capture every possible upside from every possible companies.
Sure.
Understanding company and what we are good at is important,
Hmm.
and focusing on margin of safety is essential part of risk management. So a company may be looking great on the face of it, and you see brokerages or media or houses, everyone talking about how great the business is.
Hmm.
But when I see, finally, valuations are paramount.
Right.
So anyone trading at, as I'm saying, that just making it simplistic for your viewers, paying more than 50 P
Hmm.
means you are extrapolating current growth for next many years.
Sure.
And Also, your returns are based on P expansion, not earnings growth.
Earnings growth, right? Yeah, absolutely. And in fact, at times of euphoria, and we saw that a couple of years, especially post 2020, there were a couple of years of euphoria in the markets, and a lot of people actually went ahead and started investing. The SIP started to rise. Now we are at what, 31,000 crores, in SIP. But so for someone who's actually investing in individual stocks, so what is the thumb rule for valuation during market euphorias? Buy less or hold tight, or sort of stay out, and probably look for a dip when to get into the markets. What would be your advice to investors?
I think the first thing that one has to look at is more than stocks is asset
Hmm.
allocation.
Sure.
So what percentage of your savings or surplus
Hmm.
that you are putting in which asset class? I've seen this people debating very, very hotly, what is happening to a particular stock or a particular equity, mutual fund or equity. But only 5% of his surplus is actually in equities.
Yeah, sure.
So I think asset allocation
Hmm.
is, is the starting point, and that is where people should use experts. There are financial advisors, experts that you should use in deciding what is my risk appetite and what percentage of my money should go into which asset class.
Yeah.
And second, the one that you're talking about, in a euphoric times. So it is important to reduce exposure to equities, um, uh, be more in fixed income, and then within equity asset class, I'm saying at Bajaj Life, what we do. So the move when you see that markets are euphoric, you tend to move your portfolios from high PE, cyclical companies to more stable businesses like utility,
Hmm.
increase the quality of portfolio.
Right, right.
So A, asset class level. B, within equities, move to relatively more safer, lesser volatile sectors and stocks. I think that's what we need to do.
Absolutely. Asset allocation is something which one should take note of. And for long-term investors, Srini, is valuation about entry price or time in the market? What's the golden balance rule there?
I would say time in the market builds wealth,
Hmm.
but entry price determines how well it compounds.
Ah, okay.
Yeah. So staying invested is essential,
Hmm.
but valuation defines the starting yield on capital.
Right.
So to that extent, good entry point
Hmm.
where there is margin of safety reduces your downside risk. So our approach is to own businesses that will generate sustainable growth, but enter thoughtfully.
Absolutely, enter thoughtfully, and that's where your brain and your metal comes in. With stocks to pick, and that what drives the compounding effect. Well, that's a powerful takeaway there, Shini. Reasonable price, not reckless optimism. Srinivas, thank you for sharing such clear and practical golden thumb rules on valuation. Thank you so much for taking the time out.
Thank you. Thank you for this opportunity, Kshitij.
Thank you, sir.